Welcome to the XFO Intelligence podcast channel. This is the Complex Q series, where we explore nuanced issues facing chief investment officers in an age of complex, asymmetric shocks. I'm your host, and today we're diving into a critical topic: navigating tariff shocks, dynamic scenario planning for CIOs in an era of asymmetric margin compression. Before we dive in, a quick reminder. If you find this content insightful, please like, share, and subscribe to our channel, and send any feedback to xfointelligence@gmail.com. Now, let's get into it. In May 2026, the global trade environment remains volatile. Tariff-driven cost shocks rarely behave as uniform, binary events. Instead, they lead to regime-dependent margin dynamics that differentiate transitory accounting noise from structural cash flow repricing. The critical challenge for CIOs is not predicting headline tariff rates, but deploying adaptive scenario planning frameworks that distinguish between temporary margin compression and permanent margin resets. Let's break down the core challenge: the race between policy duration and supply chain adaptation. Financial markets often react as though tariff announcements are discrete pricing events. But margins evolve over time, shaped by supply chain rigidity, contract maturities, competitive pricing power, and capital cycles. The decisive question: does the trade friction last longer than it takes for financial physical systems to adapt? When adaptation moves faster than policy duration, firms manage with inventory buffers, temporary margin sacrifice, or hedging, and margins revert. But when policy outlasts adaptation, supply chains reconfigure, pricing stabilizes at new levels, and margins reset structurally. CIOs who can price this correctly unlock asymmetric returns. Those who rely on lagging earnings miss the shift. What dynamic frameworks can CIOs deploy? Framework 1, the Duration-Adaptation Regime Model. Stop forecasting tariff rates. Track two measurable variables: the expected duration of trade friction and the adaptation timeline of exposed value chains. Policy durability comes from legislative codification, exemption rollbacks, sunset clause structures, and geopolitical bargaining. Short-term executive actions with frequent exemptions create transitory shocks. Bipartisan legislation or WTO rulings signal structural effects. Adaptation timelines come from contract rollover schedules, supplier qualification lead times, capital expenditure approval cycles, and price lags. Dual sourcing firms with modular production adapt faster than capital-intensive, single-source models. The regime classification: if friction duration is shorter than adaptation, you've got transitory compression. Favor liquidity, cyclical beta, inventory rebuild beneficiaries. If friction duration meets or exceeds adaptation, you're facing a structural reset. Focus on pricing power leaders, supply chain resilient assets, and inflation-linked exposure. Monitor customs rerouting velocity, nearshoring capital, and sustained pricing adjustments. Once physical rerouting aligns with corporate capex for multiple quarters, structural baselines are forming. Framework 2, the Asymmetric Pass-Through Matrix. Not all sectors absorb tariffs equally. Margin outcomes depend on input cost elasticity and pricing power. Plot firms on two axes. First axis: input cost elasticity. Things like supplier concentration, input substitutability, contract duration, and FX hedges. High concentration and rigid long-term contracts cause immediate cash strain. Flexible, staggered inputs delay the impact. Second axis: pricing power. This is historical price-to-cost pass-through, competitive concentration, demand elasticity, regulatory or IP moats. Sustained pass-through over 70% without volume loss preserves margins. Less than 40% plus market share defense erodes them. Quadrants: high pass-throughs of flexible inputs are structural winners. Overweight them. Low pass-through with rigid inputs are structural losers. Underweight or hedge. High pass-through with rigid inputs gives a transitory illusion. You need liquidity buffers. Low pass-through with flexible inputs are adaptive survivors. Favor them for structural overlays. Framework 3, the Dynamic Strategic Asset Allocation Recalibration Engine. Asset allocation must respond to evolving probabilities, not static forecasts. In transitory regimes, allocate to cyclicals, inventory rebuilders, and growth. In structural regimes, favor quality, low volatility, pricing power leaders, and inflation-linked bonds. Use barbell approaches for transition periods, high pass-through assets plus supply chain flexibility stocks, or short duration paired with real return assets. Triggers to recalibrate, sustained pass-through changes beyond 2 standard deviations, policy durability shifts from executive to legislative, flow synchronization across physical and financial layers, and rising earnings dispersion without volume collapse. Recalibration should happen in stages with liquidity screens and transaction cost optimization. Framework 4. Flow synchronization and leading indicators. Confirm regime transitions when physical trade flows, corporate capital deployment, and financial pricing align. Track customs shifts, nearshoring investment, supplier lead times, plus credit issuance for supply chain modernization, equity flows into pricing power leaders, and sustained contract price moves without volume erosion. When these layers converge across 2 quarters, the new regime embeds. Until that point, transitory illusions persist. Hedge this window with sector dispersion overlays, volatility scaling, and liquidity reserves. Finally, execution and governance. Separate accounting noise from cash flow reality. Adjust COGS for inventory timing, track real operating cash flows, and watch contract maturity cliffs more than headlines. Cross-validate signals against historical disruptions. Align investment policy statements with rationale and error bounds, and keep liquidity stress tests. Use algorithmic staging, monitor market impact, and maintain a 5 to 10% liquidity buffer. The key takeaway? You're not solving a macroeconomic puzzle. You're measuring a structural race. Track policy duration against adaptation friction, map asymmetric pass-through, synchronize capital with flows before consensus. Price assets on new margin baselines, not old assumptions. Maintain liquidity for transitions, deploy into firms, shortening adaptation timelines. In a world of fragmenting trade and asymmetric cost pass-through, dynamic scenario planning is foundational to resilient strategic asset allocation. The CIOs who institutionalize these frameworks will navigate tariff shocks with precision, deploy capital asymmetrically, and preserve fiduciary rigor through margin regime shifts. That's it for today's episode of the Complex Q series on the XFO Intelligence podcast. Remember to like, share, and subscribe for more insights. And drop us a line at xfointelligence@gmail.com with your feedback. Until next time, keep thinking dynamically.